Okay, let's unpack this. Today, we're diving deep into a really fascinating company at a unique crossroads. Greenidge Generation Holdings, ticker GRE. Is it a legacy power plant, a Bitcoin miner, or maybe something entirely new?
Hmm.
We're talking about a company that on July 17th, 2025, closed at 199 cents a share. It's facing some pretty significant challenges, but, potentially harboring surprising opportunities, too. What stands out to you about a company trying to bridge old world energy with new world tech? And maybe what's our mission today?
Well, what's really fascinating here, I think, is how Greenidge just embodies this high-stakes gamble of reinvention. Our mission really is to pull back the layers on this complex entity. We're going to explore what makes it such a classic, high-risk, high-reward turnaround story. And hopefully, by the end of this deep dive, you'll understand why it's been described, as a cigar butt investment.
A cigar butt.
Yeah, seemingly cheap, right? But with the potential for maybe one final valuable puff of life. The core question, really, for any investor, and for us today, is whether that puff is truly there. And, frankly, if management can successfully light it.
Okay. Before we jump fully in, just a quick note for everyone listening. Remember to like and subscribe to the Stock Analytics AI YouTube channel. For just $4.99 a month, members get priority deep dives on specific tickers. And over the next few months, we're actually covering all of the S&P 500 stocks with exclusive member access. Or if you're looking for just a one-off deep dive, you can also support us with a super thanks. Right then. To truly understand Greenidge, we need to start with its operational core. So let's dive into Chapter 1, Business Understanding. What exactly is Greenidge Generation Holdings as of today, July 18, 2025?
Okay, so fundamentally, Greenidge is a vertically integrated cryptocurrency data center and power generation company. And that vertical integration, that's really key. It's all centered around their own natural gas power plant. It's in Dresden, New York.
Right, the power plant.
Yeah, and this plant boasts about 106 megawatts of capacity. Now, what's critical is that they supply electricity directly right next door to their data centers. It creates this behind-the-meter power supply.
Ah, okay. Lower costs.
Exactly. Significantly lower energy costs, which, as you can imagine, is the single most important input for Bitcoin mining. Plus, they've got strategic access to the Millennium gas pipeline. That ensures a stable gas supply, which is also pretty important.
So this integrated setup, it sounds efficient on paper. How does that actually translate into their different revenue streams? Because their Q1 2025 results, they show a business in, clear transition.
Indeed, they do. You can see three distinct revenue streams. The largest and maybe surprisingly the fastest growing in Q1 2025 was a power and capacity revenue. That brought in about $9.2 million.
So traditional energy sales.
Pretty much, selling excess electricity back to the New York grid. Then you've got data center hosting revenue. This is where they provide turnkey solutions for third-party Bitcoin miners. Basically space, power, cooling, operational support.
Got it. Like a landlord for miners?
Kind of, yeah. That segment generated $5.8 million in Q1 2025. And that was a really pivotal shift that began with a big hosting agreement they signed with NYDIG back in early 2023. And finally, and this might surprise some people, cryptocurrency mining revenue. That's their self-mining operation. Using their own miners, that was actually their smallest segment, just $4.2 million.
Okay, so the real AHA here isn't just that they're diversifying. It's that this shift fundamentally changes the nature of the investment, doesn't it? It seems like it pivots from being this highly speculative, crypto-dependent gamble to something more like an industrial, maybe an infrastructure play.
I think that's exactly right.
That's a massive strategic bet, especially for a company of Greenidge's size and, their struggles. Can you elaborate on the significance of this revenue breakdown?
Absolutely. This breakdown, it really reveals a deliberate strategic pivot away from being a pure play Bitcoin speculation vehicle. I mean, when you combine their power and hosting revenue, that hits $15.0 million in Q1 2025. That's over 3.5 times their highly volatile self-mining revenue.
Wow.
So it means they are consciously sacrificing some of that explosive upside you might get from a pure play miner during a crypto bull run. But the trade-off is they gain much greater resilience, more predictability, especially during those inevitable crypto winters when Bitcoin prices tank and mining gets, less profitable.
That makes a lot of sense. But looking at their market position, their scale, Greenidge is still a microcap stock, right? Market cap just $27.5 million.
Tiny.
Yeah, I mean, it's dwarfed by industry giants like Marathon Digital Holdings, that's over $7 billion, and Riot Platforms, nearly $4.8 billion. And operationally, Greenidge has 119 megawatts of power capacity, 3.3 exahash per second hash rate. Just for our listeners, an exahash is a measure of computing power for mining, think a quintillion calculations per second. It's mind-boggling.
It really is.
And compared to Marathon's, 58.3 exahash per second, Greenidge really does pale in comparison.
And that difference in scale is critical. The crypto mining industry in 2025, it's mature, it's capital intensive, fiercely competitive, especially after the Bitcoin halving in April 2024. That event, it cut the block rewards in half.
Brutal for miners' revenue.
Absolutely brutal. It wasn't just less revenue, it was an immediate profit squeeze per unit of work. It forced everyone to focus relentlessly on efficiency or basically face extinction. So one of the most significant trends we're seeing in response is this pivot to AI and high-performance computing, HPC.
Oh, okay. Using the power for something else.
Exactly. Companies are realizing their massive power capacity, their specialized data centers. They're actually perfect for the energy-intensive demands of AI training. Greenidge is actively pursuing this. They've got a partnership with Infinite Reality to leverage their power assets for AI infrastructure. For them, diversifying into AI HPC, it isn't just an opportunity. I'd say it's a strategic necessity to reduce their dependence on Bitcoin economics for long-term viability.
That sounds like a potential lifeline, definitely. But for a microcap like Greenidge, is it truly realistic to compete in that, cutthroat AI infrastructure space against established giants? What's their real competitive edge there beyond just having the power available?
That's a really sharp question. Their edge isn't going to be in scale, obviously. It's in cost. And the established infrastructure they already have, they already own the power plant, they own the data center.
Yeah.
For AI, power is absolutely king, and their behind-the-meter setup gives them highly reliable, low-cost power that's just hard to replicate quickly.
So they're aiming for a niche, maybe?
Exactly. Not competing head-on with the hyperscalers. Another major industry trend, though, is the rise of green mining and ESG pressure. Over 59% of the market now is influenced by ESG-aligned operations.
And Greenidge runs on natural gas.
Which makes this both a significant risk and a strategic challenge for them. And finally, there's this ongoing institutionalization and race for scale. Bigger players are consolidating, securing better deals, and that just further complicates things for the smaller players like Greenidge.
Okay, so given all that, where does Greenidge truly stand out? What's their core competitive advantage, if they have one?
I think their primary moat, their main advantage, is that vertical integration, the direct ownership of their power plant. That provides a pretty clear cost advantage by shielding them, somewhat, from wholesale electricity price volatility. That's a major headache for many other miners.
Right, so control over power costs.
Yeah.
But you mentioned risks earlier. Is there a downside to this vertical integration? It sounds good, but...
There absolutely is. It's genuinely a double-edged sword. While it provides that control and cost advantage, especially when energy prices are high, it comes with enormous fixed costs. Huge. Ongoing maintenance, significant environmental liabilities. You can see those pop up in their financials as remeasurement of environmental liability charges. And unlike, say, asset-light hosting companies, Greenidge can't just turn off its largest cost center when times get tough. That power plant has to be maintained regardless of how much the data center is being used.
Which makes high utilization critical.
Absolutely critical for success. They need those operations running near full tilt.
Okay, now let's turn our attention to the leadership, because, who's steering this ship is absolutely crucial for a company in this kind of position. We're moving into Chapter 2, Management Evaluation. Jordan Kovler, he was appointed CEO in November 2023 after joining the board earlier that year. His background is really interesting. It's not in power generation or crypto operations per se.
No, it's not.
It's in investor relations, corporate governance, capital allocation, M&A, plus some Web3 advising.
Kovler's appointment, I think it was a very clear signal from the board. They needed a full-scale financial turnaround. The company was in a really precarious financial position, heavy debt, collapsing stock price, just a mess, frankly.
So bring in the finance guy?
Exactly.
Yeah.
And his team has executed what looks like a classic turnaround playbook. Top priority, aggressive debt reduction. They slashed $85.3 million in debt back in 2023. That was over 54% of their total debt at the time.
Wow, that's significant.
Huge. And this continued into 2025, bringing the total debt down further to about $60.2 million. This focus on financial discipline, along with cost-cutting and SG&A, forging that AI partnership, It directly reflects his capital markets mindset. The primary focus really seems to be on financial engineering and, crucially, restoring investor confidence.
Okay, but you mentioned Kovler's background is more IR and M&A, not deep power operations or crypto tech. Is that purely a strength for a financial turnaround, or could it be a potential blind spot? I mean, when it comes to the complex operational realities of actually running a power plant and a mining farm?
That's a really fair point. For a company facing such severe financial distress, a CEO with that capital markets and M&A background is probably exactly what the board wanted. Someone adept at restructuring debt, attracting capital, making strategic deals like the AI partnership. The operational expertise, though, presumably still resides in their existing engineering and operations teams.
Yeah.
The challenge is making sure there's seamless coordination, right?
Yeah.
And ensuring that the financial strategy doesn't end up compromising critical operational investments needed to keep things running smoothly or improve efficiency.
Okay. So under this new leadership, Greenidge's capital allocation strategy is sharply focused. Strengthen the balance sheet, pursue disciplined growth.
Yes, exactly. Their most significant capital allocation, as we said, has been that aggressive debt reduction. They use cash tender offers, exchange offers for their 8.50% senior notes. Beyond that, they are investing selectively in what they see as high-return projects, like expanding into lower-cost power regions. They have a 37-acre site in Mississippi, for instance, planned for about 40 megawatts of additional capacity.
Diversifying geographically, too.
Precisely. And they're also buying more energy-efficient miners, trying to improve their fleet's productivity, measured in joules per terahash, or JTH. That's a constant battle against the technological obsolescence of ASIC miners.
Those specialized mining chips.
Right, those specialized computer chips built just for mining Bitcoin. You're always chasing the next, more efficient generation.
Right.
Historically, their 2021 merger with Support.com, that's what allowed them to go public in the first place. And more recently, they've made these tactical shifts, like the Infinite Reality AI partnership we mentioned, and divesting non-core assets like their property in South Carolina.
So how does all this translate to shareholder returns? I mean, it seems pretty clear-cut here. Greenidge has no history of conducting share buybacks, and it does not pay a dividend on its common stock, GREE.
Correct.
Now, their publicly traded senior notes, the GREAL ticker, those do pay interest, but that's debt, right? Not equity returns.
And this approach, frankly, is entirely necessary for a company basically in survival mode. They have negative shareholder equity, significant debt. Their priority has to be balance sheet fortification and investing in high-return projects that can hopefully generate future cash flow. Direct returns to shareholders. That's a luxury they simply cannot afford right now. The investment thesis here, if there is one, rests entirely on capital appreciation from a successful turnaround.
What about historical returns on investment?
Well, if you look at their historical return on invested capital, ROIC, it's profoundly negative.
Ouch.
Yeah, ranging from like negative 189% to negative 234% on a trailing 12-month basis. This indicates pretty significant historical value destruction. Reversing that trend is the central challenge for this management team.
All right, now for the really hard numbers. Let's move into Chapter 3. Financial analysis. Let's unpack the key metrics as of mid-July 2025. Market capitalization, $27.48 million. Trailing 12 months revenue, $59.4 million. Net loss for fiscal year 2024, nearly $20 million, specifically negative $19.78 million.
Still leading cash.
Yeah, and total debt as of March 31st, 2025, $67.17 million. But the most striking figure, the one that really jumps out, is their total shareholder equity. As of March 31st, 2025, it's negative $58.2 million.
Technically, yes.
Yeah.
Negative shareholder equity means liabilities exceed assets on the books.
Yeah.
Negative $58.2 million. That is a truly significant hole to dig out of.
How does a company even keep operating, practically speaking, with a balance sheet that looks like that?
Well, it's really a testament to the management's focus on debt renegotiation, maybe creditor patience, and perhaps the perceived underlying value of their physical assets, like the power plant, despite how it looks on the balance sheet. But you're right, it means they have virtually no margin for error. Any hiccup could be catastrophic.
And their revenue trends reflect that volatility.
Absolutely. Revenue has mirrored the crypto market's wild swings. It peaked over $100 million back in the 2021 boom, but then declined sharply to $59.5 million in 2024. Profitability, even more elusive. They've consistently operated at a loss except for a brief, shining moment in 2021. As of March 2025, all the key margins are negative. Gross margin at 26.3%, which isn't terrible itself, but operating margin, TTM, is negative 36.0%. Net profit margin, TTM, also negative 36.0%.
So costs are just overwhelming revenue.
It highlights the heavy burden of those fixed costs from the power plant, depreciation on assets, and of course, significant interest expenses from their debt.
Okay, let's turn to cash flow next. What's the story there? Is the company generating cash from its operations?
It's, not really. Greenidge has consistently had negative free cash flow for the last 5 years. There was one tiny positive blip in 2022, but otherwise consistently negative,
Theme.
meaning their cash from operations hasn't been enough to cover their capital expenditures, the money they need to spend on maintaining and upgrading assets.
Which is a major concern.
It is. It signals a continuous reliance on external financing, like issuing more debt or equity, just to keep the lights on and operations going. If you look at their 5-year financial summary table, say from 2020 to 2024, it just starkly visualizes their journey. You see that explosive growth in 2021.
The crypto boom.
Right, followed by a sharp decline. Persistent operating and net losses in 4 out of those 5 years, and then the dramatic erosion of shareholder equity deep into negative territory. It's not a pretty picture.
So in terms of financial stability with negative shareholder equity, the traditional debt-to-equity ratio, it's kind of meaningless, isn't it?
Pretty much useless, yeah.
But comparing the $67.2 million debt to their $27.5 million market cap, that debt load looks crushing. It's almost 3 times their market value.
It's a significant burden, no question. Now, their current ratio, which measures short-term assets against short-term liabilities, was 1.41 in Q1 2025.
Which sounds okay. Above 1 is generally good.
It suggests short-term solvency, yes, they can cover their immediate bills. But here's the caution. About $8.4 million of those current assets are volatile digital assets, primarily Bitcoin. And those may not be easily converted to cash at their stated value, especially during a sudden market downturn. So it adds an element of risk, to their short-term liquidity picture.
Okay, so let's talk valuation. What's the story here? Given their negative earnings, a standard price to earnings or PE ratio obviously isn't applicable.
Right. You can't divide by 0 or a negative number meaningfully. So a more useful metric for a company at this stage often is the price to sales or PS ratio. Greenidge trades at approximately 0.46 times its trailing 12-month sales.
0.46. How does that compare?
Well, that is a deep discount compared to peers like Marathon Digital and Riot platforms. They both trade around 9.5 times sales.
9.5 versus 0.46. That's vast.
That's a vast valuation gap. And it really reflects the market's profound skepticism about Greenidge's future and the significant balance sheet risk we've been discussing.
What about something like a discounted cash flow model? Can you even do one?
A DCF model for Greenidge is highly speculative. Because their cash flows are so unpredictable and currently negative, for educational purposes, you could build an optimistic turnaround scenario. But you'd have to use a very high discount rate, maybe 15%, 20%, even higher, to account for the extreme risks involved. And if you do that, if everything goes right, you could theoretically arrive at an estimated intrinsic value significantly higher than the current share price.
But that's a big if.
A huge if. It's crucial to understand this isn't a price target. It's an exercise in potential, showing what could happen. The current stock price, however, clearly reflects the market assigning a very low probability to such a successful outcome actually happening.
Okay. We've just laid out Greenidge's core business, its shaky financial health, and the management team trying desperately to turn things around. After a quick break, we're going to shift our focus outwards. How is the market really perceiving all this? Who actually owns the company? And crucially, the multitude of risks that stand in its way. Stay with us. Music fades in briefly and then out. Welcome back to the deep dive. Before the break, we really dissected Greenidge's internal workings, the business, the management, the financials. Now let's turn our attention outwards, feel the market's pulse on this, fascinating and, let's be honest, deeply troubled company. We're moving into Chapter 4, Market Sentiment. How is the market actually feeling about Greenidge? You said earlier, a mix of deep skepticism and maybe some speculative optimism.
Yeah, I think that's still an accurate read. Despite its small size, Greenidge does have some analyst coverage, though it's limited. The average one-year analyst price target for the stock is around $4.08.
$4.08. That's over 100% potential upside from its current $1.99 price.
It is. But the forecast range is notably tight. It runs from $4 to $4.20. That suggests very limited, maybe only one or two analysts actively covering it. And you have to view these targets as a best-case scenario. They're absolutely predicated on successful execution of the turnaround plan, and frankly, you have to assign a pretty low probability to them actually hitting that.
Right. What about recent news flow? Anything significant moving the needle?
Most of the recent news has focused on that financial restructuring, the debt reduction efforts, and operational updates, like the AI partnership. The tone in their press releases, unsurprisingly, has been, let's say, cautiously optimistic.
But there's a shadow hanging over them, isn't there? The NASDAQ compliance issue.
Yes, and that's a significant negative signal that really tempers any optimism. Greenidge is currently non-compliant with NASDAQ's minimum bid price requirement. They traded below $1 for an extended period. This puts them at real risk of being delisted from the NASDAQ exchange.
Which would be bad.
Very bad. It deters institutional investment even further, makes it harder to raise capital, and can severely damage overall investor confidence. It's a serious overhang.
Okay, let's look at some specific market indicators. Starting with short interest. How many people are actively betting against the stock?
Well, the short interest, as a percentage of the float, is actually relatively low. It's sitting around 3.05%.
3%? That doesn't sound huge.
It's not. It suggests that maybe sophisticated short sellers aren't making a large, concentrated bet on the company's collapse. They could be because the stock is just too small, too illiquid to attract significant attention from large hedge funds. Or maybe they see enough potential for a sharp rebound, a short squeeze risk that makes it unattractive to short aggressively.
Interesting. What about moving averages? Are the technical charts telling a different story from the fundamentals?
They kind of are, actually. Their 50-day simple moving average is around $1.71. Their 200-day simple moving average is $1.47.
And the stock's at $1.99 now.
Exactly. The current share price is comfortably above both of those key moving averages. Typically, that indicates positive short-term and longer-term momentum, technically speaking. So this creates a really notable disconnect, doesn't it, between the dire fundamentals we just spent time discussing and these more positive technicals, plus those optimistic analyst targets.
Yeah, it's weird.
It's very characteristic of what people call a story stock, or a turnaround play. The market seems to be pricing in the possibility of a successful turnaround, even if the hard numbers aren't quite there yet. Hope, perhaps, over reality.
All right, let's shift gears slightly. Next up, Chapter 5, ownership structure. So who actually owns Greenidge, and what does that tell us about its potential trajectory? Because you mentioned their ownership profile is highly unusual.
It really is, yeah. And it's central, I think, to both the bull case and the bear case for this stock. The headline is, institutional ownership is exceptionally low. It's sitting at approximately 4.9% of outstanding shares, just under 5%.
4.9%. That is low for a public company.
Extremely low. And what's more telling is who those institutions are. The top holders aren't active, fundamental-driven investors making a big bet on Greenidge. They're primarily passive index funds like Vanguard or Geode Capital Management who have to own it because it's in an index, or they're quantitative trading firms.
So not the big conviction buyers. What are the deeper implications of that, this low institutional ownership?
Well, this conspicuous absence of what people sometimes call smart money has to be seen as a significant warning sign. Many large funds, they have screens. They automatically filter out companies with Greenidge's kind of financial red flags, the negative equity, the unprofitability, the going concern risks we talked about.
So it's basically uninvestable for them.
For many of them, yes. Their mandates just don't allow it. This, in turn, concentrates the ownership much more heavily in the hands of retail investors and insiders. And that typically leads to more volatility. Stock price movements can be driven more by individual speculative bets or sentiment, rather than long-term institutional conviction based on fundamentals.
Okay, but you said this was central to the bull case, too. How does that work?
Well, here's the flip side. And it's arguably the most compelling piece of evidence for the bull case right now. What are the insiders doing?
The management team.
Exactly. After some insider selling back in late 2024 and maybe early 2025, the trend sharply reversed in the second quarter of 2025. We saw top executives actively purchasing their own company's stock on the open market with their own money.
Okay, that is interesting.
It's a powerful signal. You've got CEO Jordan Kovler making multiple purchases in May 2025. The CFO, Christian Mulvihill, pivoted from selling shares to buying them in May 2025. And director Christopher Krug made several really significant purchases in April and May 2025, acquiring over 250,000 shares.
250,000 shares.
Yeah. Look, the old saying on Wall Street is true. There are many reasons for insiders to sell: stock diversification, taxes, buying a house. But there's generally only one reason for them to buy.
They think the stock is going up.
Exactly. A genuine belief that the stock is currently undervalued and will rise. It strongly suggests that those with the most intimate knowledge of the company's operations and turnaround plan believe the market is mispricing the potential. They think the turnaround is actually on track, more so than the market believes.
That's definitely food for thought. It's also worth just briefly mentioning, wasn't Greenidge historically a controlled company by a private equity firm, Atlas Holdings?
Yes, that's right. Atlas Holdings LLC was the controlling shareholder for a while after the merger. And having significant block ownership like that can definitely influence strategy, sometimes in ways that might primarily benefit the controlling shareholders rather than all shareholders equally. That influence seems less direct now, but it's part of the history.
Okay, let's move squarely into the risks now. Chapter 6, Risk Assessment. Every investment carries risk, we know that. But for Greenidge, the risks seem particularly numerous and, well, substantial. Let's try framing this with a SWOT analysis: strengths, weaknesses, opportunities, threats.
Okay, sounds good. Let's start with strengths. We've talked about their vertically integrated model owning their power plant. That's a potential cost advantage. They also presumably have strong in-house expertise in running these kinds of 247 industrial assets. And crucially, right now, they have that turnaround-focused management team with what seems to be a clear mandate for financial discipline.
Okay, strengths noted. Now, the weaknesses, this list might be longer.
Yeah, probably. The severe financial distress is number one. Negative shareholder equity, consistent losses, negative free cash flow. It's a tough starting point. Then there's the heavy debt burden we discussed. Their limited scale as a micro-cap company puts them at a significant disadvantage against giants. Plus, there's significant asset concentration risk. Almost everything hinges on that single power plant in Dresden, New York. That makes them vulnerable to localized issues, regulations, physical problems, anything.
Right. What about opportunities? Where's the potential upside beyond just surviving?
The pivot to AI and high-performance computing, HPC, that's the big one. It could potentially open up a new, more stable, maybe even high-margin revenue stream if they execute well. They also have opportunities, like that Mississippi site, to expand into other low-cost power regions. That could significantly de-risk their single-plant concentration over time. And of course, you can't ignore the potential impact of continued institutional demand for Bitcoin, which could still benefit their remaining crypto operations, both hosting and self-mining.
Okay. And finally, the threats. What external factors could derail this whole thing?
Bitcoin price volatility. That remains a huge factor, completely outside their control. Even with diversification, a crypto crash would still hurt them significantly. There's the intense competition and the ever-increasing mining difficulty. This demands constant capital expenditure on new, more efficient miners just to stay competitive. It's like being on a treadmill you can never get off.
Like buying a top-of-the-line race car, only to find out a new, faster model comes out every 6 months.
Exactly. You're constantly having to upgrade just to stay in the race. And then, critically, there's the regulatory scrutiny, particularly the environmental concerns surrounding their natural gas power plant. That's a major, major threat.
Okay, so beyond the company itself, what about the bigger picture? Macroeconomic factors, geopolitical stuff, how does that play in?
Well, inflation and high interest rates are definitely a factor. High rates make refinancing their existing debt much more difficult and expensive. Inflation itself increases their operating costs, labor, supplies, gas maybe. It erodes purchasing power generally.
And geopolitics. Does that matter for a U.S.-based miner?
It does, primarily through the supply chain for mining hardware, those specialized ASIC chips. The manufacturing is heavily concentrated in Asia, particularly China and Taiwan. So things like U.S. tariffs on electronics imports from Asia or any supply chain disruptions. Those could directly increase Greenidge's capital costs when they need to buy new miners. But I have to come back to it. Arguably the most significant external threat is environmental regulation.
Specifically for them because of the natural gas plant.
Precisely. As a fossil fuel-powered miner, Greenidge is, frankly, a prime target for environmental scrutiny and potential regulation, especially in a state like New York, which has aggressive climate goals. Things like potential carbon taxes, stricter emission standards, or even broader limitations on using natural gas for energy-intensive operations like crypto mining. Any of those could fundamentally undermine their core cost advantage. It could threaten their entire business model. It's an existential risk for their specific setup.
Okay. This paints a complex, high-stakes picture, which brings us neatly to our final chapter. Chapter 7, Conclusion. So, after digging through all of this, The business model, the financials, the management, the market sentiment, the risks. What does it all add up to? Is Greenidge Generation Holdings a phoenix rising from the ashes, or maybe just a house of cards waiting for the next gust of wind?
It really feels like it's at a critical inflection point, doesn't it? It's
Yeah.
such a classic high-risk, high-potential reward turnaround story. And the signals are just incredibly conflicting.
Okay, let's try to summarize each side clearly. Let's start with the bull case. Why might someone still believe in Greenidge despite all the problems?
Point one has to be that strong insider confidence, right?
They're buying, yeah.
The CEO, CFO, a key director, all putting their own money in recently.
Yeah.
That's arguably the most powerful positive signal right now.
Okay, what else?
Second, there is a credible turnaround strategy underway. You can see the focus on aggressive debt reduction, cost-cutting, overall financial discipline. It looks like they have a plan. Third, they possess a unique and potentially defensible asset in that vertically integrated power plant. It offers a crucial cost advantage in a very energy-intensive business if they can manage the environmental side.
The AI pivot.
Fourth, exactly. The strategic pivot to AI and HPC is a smart move, potentially. They could diversify revenue streams, tap into secular growth that goes way beyond crypto volatility.
And lastly, the valuation.
Yeah, fifth, that deeply discounted valuation, particularly on a price-to-sales basis compared to its peers. It just offers significant potential upside if the turnaround actually succeeds.
Okay, that's the bull case. Now, let's counter with a bear case. What are the key challenges that could sink this ship?
Well, number one is still the severe financial distress. The negative equity, the history of consistent losses, the persistent negative free cash flow, the balance sheet is just incredibly weak. Second, the substantial debt load. Even after reductions, it remains high relative to their market value and their capacity to generate cash. It's a constant drain.
Bitcoin dependency.
Third, yeah, that inescapable Bitcoin dependency. Even as they try to diversify, their financial health is still intrinsically tied to the price swings of a highly volatile asset that's completely outside their control. A bad crypto winter could still be fatal. Fourth, intense competition. This is a micro-cap company trying to survive, let alone thrive, against multi-billion-dollar giants in a very capital-intensive industry. Scale matters here.
And the biggest threat.
Fifth, that existential regulatory risk. Specifically, the environmental scrutiny targeting its core asset, the natural gas power plant. Stricter regulations could completely undermine their business model. It's a huge sword hanging over their head.
So let's just briefly recap the evaluation summary we talked about in Chapter 3. A traditional DCF is super speculative here.
Highly speculative, yeah.
But if the turnaround succeeds, such a model could potentially show an educational intrinsic value range significantly above the current $1.99 share price.
Correct. But again, we have to stress this is not a price target. It just illustrates the potential value that could be unlocked if and only if management successfully executes this incredibly complex high-wire strategy.
Okay, so what's the final concluding outlook then? Where does this leave us on Greenidge, GREE trading at 199 cents?
I think the concluding outlook has to be that Greenidge presents as that quintessential cigar butt investment we mentioned at the start. It's a financially distressed asset, available very cheap relative to its past or potential future. It might have, one or two puffs of value left if things go right. It's definitely not a wonderful company at a fair price. It's a bet on radical transformation, on a turnaround against long odds. The compelling insider buying, though, that does suggest that those closest to the company believe success is perhaps more probable than the deeply discounted market price currently implies. Ultimately, an investment in GREE today is less about the company's current state and almost entirely a bet on the skill, the execution, and maybe a bit of luck of its management team to navigate these incredibly treacherous waters.
Which leaves us with a really thought-provoking question for you, the listener. Considering Greenidge's dire financials, balanced against these bold strategic moves and that strong insider conviction, are you seeing a phoenix rising from the ashes here? Or is it just the last flicker of a dying flame? And that wraps up our deep dive into Greenidge Generation Holdings. We certainly hope this has given you a shortcut to being well-informed on this, incredibly interesting and complex company.
Yeah, remember, gaining knowledge is always invaluable. And understanding these kinds of complex stories, I think it helps us all connect the dots in the bigger economic picture.
Absolutely. And don't forget to like and subscribe to the Stock Analytics AI YouTube channel. For just $4.99 a month, members get priority deep dives on specific tickers. Plus, remember, we're covering all of the S&P 500 stocks over the next few months, and members get exclusive priority access. Or if you just want a one-off deep dive on a company you're interested in, just drop us a super thanks. We appreciate the support.
And finally, just a crucial disclaimer. This analysis was generated by an AI system. It's intended for educational purposes only and should absolutely not be considered financial advice.
Please.
Always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Well said. Until next time, keep digging for those nuggets of knowledge.